later. So guys, we work with dozens of A-rated financial and insurance companies, allowing us to create the best savings and protection solutions for you and your loved ones. I'm sure you recognize some of these logos down here, right? Mutual of Omaha. Most people know Wild Kingdom, right? For whatever reason, that's the number one household name right there. And for what it's worth, our company helps families with more Mutual of Omaha policies than Mutual of Omaha themselves. True story. So we've got excellent relationships in the industry, AIG, F&G, Foresters, Lincoln, you name it, we're probably working with them. So why Index Universal Life for children? Well, Index Universal Life Insurance is one of the more innovative wealth building options available today. The difference is that this also provides a buildup of cash inside the policy, right? The cash is not exposed to market risk and it can be accessed tax-free. So it's liquid, right? You can see some benefits on the infograph there, and I'm going to get into those a little deeper as we move forward. So if you would bear with me, guys, I'm just going to hit some high points, ladies and gentlemen, why IUL for children could be ideal, all right? Number one, tax-free growth. You're going to hear it definitely more than once throughout, because this is something that, most of us are seeking when it comes to savings, right? It's tough to save and compound interest when you're being taxed on it consistently. And we'll show you why this is a specially tax advantage vehicle. You can use the funds for tax-free income, right? You can open a plan for your child as early as 14 days after birth. And cash values can be used by your child for any financial need in life, including education, down payment on a home, starting a business, and even to provide financial security for their future family. You can use the funds in the plan while it continues to grow. I'll go into that a little more in detail, but while your principal's in there growing, you can actually utilize the funds at the same time. That's the very exciting component to these. Steady, predictable growth. Parents, grandparents, legal guardians, aunts, or uncles can open these plans and they will own and control the policy for as long as they like. Ownership can be handed over to the child at any time you desire. You're the owner, tax-free after they turn 18. And like I said, you can have your own benchmarks. Maybe it's when they turn 30, right? Maybe it's at a different point in time. But because it's a life insurance plan, your child will be permanently covered regardless of any illness that may arise. And this is an asset that either you or your child can use for retirement. We'll explain how that works in a minute. So what does Index Universal Life do? I'll go over that really quickly. When you qualify for an Index Universal Life policy, that's exactly what it is, right? By definition, this is a life insurance policy. So you're getting permanent coverage as long as those premiums are paid. It's a life insurance policy with a death benefit, which of course is paid out to the named beneficiary when the insured passes away. So it works just like, insurance policies that you and I understand. What's very special about the benefits here, as far as health is concerned, is that it also includes living benefits in the case of critical illness, like stroke, heart attack, or cancer diagnosis, chronic illness, which is the inability to perform a number of daily tasks of living, or terminal illness. So this is all built into protection for you and yours when you get these. Now, the purpose we're using these for, that's a byproduct that comes with it automatically because that's what this is, right? But what's interesting is, what does it do? It increases in value during your lifetime through a cash value component that grows tax-free and can be accessed tax-free. So the cash value portion of the policy earns interest based on the performance of an underlying market index, like the S&P 500. But what's special about these is even if the index goes down, your credited interest rate is never less than 0% guaranteed. What that means is if the market is going down, you don't lose any money. And that's what's very special about these. They put in what we call floors so that when the market goes down, you don't lose any of your money. You only have upside potential. And they usually cap the upside. I mean, that's the trade-off. They'll usually cap the upside at anywhere from 10 to 14%, depending on who you're working with. Most of ours are 14%, the ones that we work with. But I want to show you this graph really quickly, just to show you the power of having that protection in place, as opposed to being directly invested in the market. So this demonstrates how $100,000 in investment, right? We're not suggesting, this is just for arbitrary figures to show you the capacity of these programs, right? So it's a 20-year investment, let's call it, right? If you invested a certain amount of money here back in 2000 directly in the market, look what happens. You're experiencing those ups and downs, right? When the market goes down, your portfolio goes down, and then you got to catch up. It goes up and up and down and up and down, right? Well, with the floors in place, you can see this never breaches zero, right? We're looking at the blue line here now. Never breaches zero. So we don't have to be an investment expert to understand that by not losing money, we have tremendous upside here, right? Because we don't have to catch up for those times that we went down in the market. And here's the difference. The actual rate of return, even though there's a cap here, right? I mean, this thing went up to 26%, 28%. We never made more than 12% here, right? But with those zero floors, here's what's so powerful about this. You got an actual rate of return of 6.48% tax-free versus a 4% rate of return when invested directly in the market. Now, in this particular scenario, this portfolio, that's an additional $131,255 in cash value. Who wouldn't want that, right? How is this possible? The IRS has a rule. It's Rule 7702. And what it does, guys, is it differentiates between the income from a genuine insurance product and income from an investment vehicle. Life insurance contracts are protected. They receive favorable tax treatment. So we get to take advantage of this for our savings programs, right? So in addition to a death benefit that typically passes tax-free, the cash value of permanent life insurance grows tax deferred and will never be taxed so long as it stays in the policy. So we'll show you how to do that. The key advantage here is you can borrow against the cash value tax-free, and the funds can be used for whatever purpose, and they're paid back whenever you decide, right? You're your own creditor here. What if I don't pay it back? Well, that simply comes out of the death benefit that's already built into there, right? So again, anything you do not repay is simply subtracted from the death benefit upon the insurance passing. So the key to wealth building is understanding the rules, right? So here's a great quote from Tom Wheelwright. He's a CPA, I believe, here in Arizona. Great book on tax-free wealth. Most people think the tax law is a ball and chain meant to rob you of your hard-earned money. Wrong, as he puts it. The tax law is a series of incentives that can make you rich faster than you ever thought possible. It's just how we use these rules, right? And we can show you how. That's what we do for our clients. So leverage your wealth with Index Universal Life. Again, guys, we're talking about the people we care about most. This is for anybody, but tonight we're focusing on helping children and grandchildren and provide for their future, build a reliable income stream, save for college, right? Have that down payment for their first house, fix the car when it breaks down, right? The funds for your IUL loan do not subtract from your policy's cash value. Instead, you're borrowing against the funds inside your policy. So let's say, for instance, you built up $50,000 of savings in there, and you want to take out $20,000 for a school tuition. Well, you're not actually taking the money out. You're borrowing against your cash value at a very low rate. Now you're able to utilize that $20,000 per se for tuition or what have you, and you've still got $50,000 in there growing, right? Because you're just borrowing against it. So I'll show you what that does. It's pretty mind-blowing as far as how your growth will compound with that little piece in place. So this distinction is important, again, because it means that cash remains in your policy and continues to earn investment income while the loan is outstanding. That's very different from a 529 plan, which removes the funds from your account and reduces your investment performance going forward, right? You have 10,000 in there and you take out 2, you've only got 8 in there growing. So again, here's our focus. We are building wealth for children. We're very passionate about this because though, a lot of us learned this late in life, right? Some of us are still learning, and maybe you're just learning today, hopefully, because that's why we're here, is to educate. Our mission as a team is to educate so that the next generation already has this in place and knows to put it in place for theirs, right? When they have children. It's something that we care very deeply about, and we're grateful for you attending this and wanting to be educated yourselves on this concept. So an IUL for children is flexible. The growth is tax-free, and the funds can be used for education, a down payment on their first home, opening a business, and so much more. And the overall utility of these are extremely versatile when it comes to a child's financial future accordingly, right? With certain plans like the 529, that can only be used on education if you want it to remain tax-free. Not so with Index Universal Life. With Index Universal Life, you can use those funds however you please, and it can remain tax-free. So many parents, like me and my wife, wish to give their kids a head start wherever they can. So today we're going to look at using an IUL for college savings as an example. Before we get into that, let's go over some statistics, because who doesn't love statistics, right? Actually, these are pretty interesting and blew my mind. These are as of 2022. College planning. If you look at some of these costs that this upcoming generation is facing, the average cost of college in the United States is $35,000 per student per year, and that includes books, supplies, and daily living expenses. This is average, of course. The average cost of college has more than doubled in the 21st century, with an annual growth rate of 6.8%. The average in-state student attending a public four-year institution spends $25,487 for one academic year on average. And the average cost of in-state tuition alone is $9,300 a year, and out-of-state tuition averages $27,023. The average traditional private university student, we all know how those can be, spends a total of $53,000 per academic year, $35,000 of it on tuition and fees. Considering student loan interest and loss of income, the ultimate cost of a bachelor's degree can exceed $400,000. That's why we're in the middle of a school loan crisis, right? There are debates all over the place. Should they be forgiven? Should they not? We're not here to get political or weigh in on that right now. It's simply a hot topic for a reason, right? People are taking on enormous amounts of debt just to get educated in this country. Well, what if you could plan ahead, right? What if you could have that in place ahead of time so they wouldn't be subject to those worries? That's why we're here to help. Okay, so we're going to compare IUL to the 529 plan. 529, for those that don't know, is probably one of the more popular means of saving money for college or university, right? It is a program put on by the government that allows you to invest in mutual funds, the market, what have you, and have that money grow tax deferred. So if you're in one of these, pat yourself on the back. Saving is saving, right? Growing money tax-free is growing money tax-free. It's a great thing that they put forth. Why we prefer the IUL and why we're educating people on the IUL is we feel it has some key advantages that the 529 plan does not. So again, I'm going to go down these line items and just compare. Tax deferred growth. Well, we talked about it. Does the 529 do that? Absolutely it does. Does the IUL do that? Absolutely it does. As long as it's inside there, it grows tax-free, right? Are the distributions non-taxable? Yes, they are in an IUL, so long as you take it in the form of that loan, right? You never have to take the money out of there because the principal you want to keep in there growing. The 529 plan is also non-taxable. Now there's an asterisk here. The asterisk being only if it's used for educational purposes, right? So that brings us down to our next line item. Is there no penalty or restrictions for non-educational usage? For the IUL, yes, there's no penalty. I hope that doesn't confuse, right? Don't want to have double negatives or any of that, but there is no penalty for using an IUL for non-educational expenses. 529, there is a penalty, right? You will be taxed if you use this. Let's say your child, they're ready to, they turn 18, it's time for college. They decide, I don't want to go to college, right? I want to start my own business, or I want to take a year off and travel. I want to become a travel blogger, who knows what. The fact is, with a 529 plan, now all that tax-free savings is going to be taxed because they've opted to not use it for education. Not so in an IUL. Is there protection from market downturns or loss? With an IUL, yes, there is. Remember those floors we showed you a few slides ago. Guaranteed, you will not lose money when the market goes down. There's a zero floor there. So when the market breaches zero and goes down, you do not suffer those losses in your portfolio, right? With a 529 plan, there is no protection. You're invested directly in the funds, the mutual funds, et cetera, the EFTs, stocks, what have you. And when they go down, so does your portfolio, right? Now, God forbid anything happen. God forbid there's a chronic or critical illness that takes place and throughout a child's life. The IUL has protection built in, right? There's a benefit for that, a financial benefit if God forbid you were diagnosed with something and needed that money. It's there, right? With a 529 plan, no, these are not insurance plans. They're just tax deferred savings vehicles. Is it not counted as an asset when again, I apologize for the double negatives. I'll adjust the slide for our next presentation. Is it not counted as an asset when applying for federal financial aid? And guys, the reason I didn't have time to correct this is something that our team has been doing for years, but we've been so compelled with everything going on in the markets, especially now and what many people believe is coming. And looking at, when we're talking to our clients, what they really fear for their children is financial well-being, making sure they're set up, hoping they don't fall, prey to these huge loans and then they get out and where's the salary to cover the loans, right? So we took it upon ourselves to say, we got to get to market with this so that we can educate everybody and let them know that there might be a better way, right? So anyway, is it not counted as an asset when applying for federal financial aid? So with an IUL, it's not an asset when applying for federal financial aid. You could have $1 million in there and if need be, still apply for the federal financial aid. With a 529, those funds do count against any financial aid you planned on applying for. So they can't not be used in tandem. Now, here's my favorite part. A lot of words here, guys, but for a reason. I just want to show you an example, okay? A lifetime of financial benefits with IUL. So assuming the market continues to grow at its 30-year average rate, now mind you, in there was COVID, the mortgage crisis, I want to say Black Monday, but no, I'm older than that, unfortunately. But in the last 30 years, we've had a few significant market downturns, and maybe we have another one coming up, according to some. But in spite of all that, an average rate of 8% return, right? And you put just $100 a month into the account through age 18 and then stop. So you got a newborn. Now, this is not just for newborns. This is just an example, right, to show you how this works. This is for everybody. I have one of these. My wife has one of these. We have them for my children. I guess I'm not at liberty to say who else in my family has them, but we're big believers in this throughout my family. So, guys, $100 a month at birth through the age of 18, and then you stop. Your child will have tax-free access to $10,000 a year for each of 4 years of college, a $50,000 tax-free distribution at age 35. These are on top of each other. These aren't either ors, okay? So maybe a house down payment, right? A tax-free distribution of $250,000 at age 55, $250,000 at age 55. And then on top of that, tax-free annual distributions for life of over $200,000 a year, starting at age 67. And here's the mind-blowing part. We're talking legacy now. On top of all that, the death benefit in this policy will have gone up from $115,000 when put into place at issue to over $1.6 million at age 66 with no additional out-of-pocket costs. How is that possible? Well, did you guys know if you were to take oh gosh, I don't have the exact riddle, if you will. It's not a riddle, but I just did this to my kids the other day, and it's fascinating. If you ask people, hey, would you rather I give you $1 million today, or I'm going to give you a penny today and I'm going to double the amount for 30 days? Which would you take? Most people, unless you're like, this must be a trick question, right? What's he talking about? But most people at face value are going to take the $1 million, right? But a penny doubled every single day for 30 days, I believe equates to about $4 million. That's the power of compound growth. We're not talking insurance or 529s or IULs or 401ks, right? That's just how compound growth works. And we're taking advantage of that inside of this tax-free vehicle, which allows for compound growth with no market downside, right? So real quick, I just want to cap it there. I'm going to go over a few things just so people understand that this is versatile. You can use it for so many things. Our very own Steve Devine is going to present. We'll come out with a date here, but we're going to be talking about IULs versus 401ks coming up. Entrepreneurs use IULs. Many entrepreneurs that you've heard of, certainly Ray Kroc, right, borrowed against his permanent life insurance to fund marketing campaigns for McDonald's. You know, the couple of stores they had, it grew to more than 700 restaurants in 10 years because of that. And of course, we know that McDonald's is just all over the place, right? Walt Disney, when nobody else would give him the money, how many people have been impacted positively by Disney World, right, or Disneyland when they were kids? Walt Disney borrowed from his life insurance in 1953 to help fund Disneyland, his first theme park, when no banker would lend him the money. And Doris Christopher, who created Pampered Chef, she sold that to Warren Buffett for $900 million. Just 7 years earlier, she borrowed from her permanent cash value to found the company. Amazing, right? And Senator John McCain secured initial campaign financing for his presidential bid by using his life insurance policy. So pretty cool. And guys, later on we'll be talking, not tonight, of course, we're just about through here, but wanted to educate you on how this can help your children and grandchildren. But business owners, lots of benefits there too. And just keep an eye out for us on, you know, whoever invited you to this, follow them on Facebook, guys, because we're going to be doing some exciting stuff and teach you all kinds of things. So let us help you give your favorite people a head start, please. It would be our pleasure. It's our mission to educate and then help, right? Reach out to the agent that invited you, and we will help design a plan for your child. Whether it's $25 a month or $1,000 a month or anywhere in between, a little savings will add up to a lot, particularly with children and grandchildren, when they've got all those years for that compound growth and will be protected throughout. So please reach out to whoever invited you. We're not only going to give you an illustration to show you exactly what this looks like throughout their life, you know, how the cash value will grow, but we have a free gift for you about, it's a book about tax-free wealth that we will email you upon request. Just let the agent know and they will send you a really easy to read book about tax-free wealth. And I promise, if you haven't read it before, it's going to be eye-opening, might even blow your mind. So give us a call, shoot us an email, keep an eye out on your agent's Facebook page, LinkedIn, otherwise. And love sharing this quote, right? Always plan ahead. It wasn't raining when Noah built the ark. So time to start now. And that's it, guys. I'm going to stop the share. I want to thank you each and all for attending tonight, and really appreciate you taking the time. And I hope your family will appreciate what it is you can do for them if you so choose to accept this mission, as they say, right? Mission impossible. And then make sure you throw that tape away because it's going to explode afterward. Guys, thank you for making the time, taking the time. I hope you will reach out to the professional that invited you to this event so that we can show you what this looks like on paper, right? Get down to the nitty gritty. It only takes about 10 to 15 minutes to walk you through an illustration. And if you decide it's something you want to proceed with, great. That's why we're licensed throughout the states throughout the country and able to help any and all that desire to do things a little differently here than most. And hopefully we get to flip that on its head in the next generation, and everybody will be using this for their tax-free wealth strategy. Thank you again. I hope everybody has a wonderful night.